Look, I need to be direct with you about something that's keeping most people up at night, even if they won't admit it. While everyone's celebrating their stock portfolios and patting themselves on the back for their 401k gains, there's a massive blind spot that could wipe out decades of wealth building in a matter of months. And the scary part? Most people won't see it coming until it's too late. Here's what I mean. Right now, as I'm recording this, central banks around the world are buying gold at levels we've never seen before. Not just buying it casually, but accumulating it like their survival depends on it. Over the past 3 years, they've purchased more than 1,000 tons annually. That's not normal. That's not routine portfolio rebalancing. That's preparation for something big. Think about what that means for a second. These are the same institutions that print money, that control interest rates, that have access to economic data you and I will never see. They're the ultimate insiders, and they're converting their paper assets into physical gold at a pace that's frankly alarming. Goldman Sachs is now forecasting gold at $4,900 per ounce by the end of next year. Let that sink in. That's not some fringe newsletter prediction. That's Goldman Sachs. But here's where it gets really interesting, and this is what most people miss. The gold market isn't like the stock market. It's not transparent. It's not efficient. And it's absolutely not fair. There are forces at work that have been suppressing the true price of gold for decades, and those mechanisms are starting to break down. When they finally snap, and they will snap, the repricing is going to be violent and swift. Let me paint you a picture of what's actually happening behind the scenes. The COMEX, which is the major exchange where gold futures are traded, operates on something called fractional reserve. Sounds familiar, right? Just like banks don't actually have all your deposits sitting in a vault, the COMEX doesn't have nearly enough physical gold to cover all the paper contracts they've sold. Some estimates put the ratio at over 100 to 1. That means for every ounce of actual gold sitting in their vaults, they've sold claims to 100 ounces. Now, as long as everyone's happy trading paper and nobody asks for delivery, the system works fine. But what happens when people start demanding physical? What happens when countries decide they want their gold back? What happens when investors lose faith in paper promises and want the real thing in their hands? The whole structure collapses. And we're starting to see the early tremors of that collapse right now. China's been quietly accumulating gold for years, but recently they've accelerated. Russia's been doing the same. India's demand is insatiable. And it's not just governments. Wealthy families, hedge funds, and institutional investors who understand what's coming are moving into physical gold in size. They're not buying GLD or paper ETFs. They're buying bars and taking delivery. That's the key detail everyone misses. Here's a story that illustrates this perfectly. Back in the early 2000s, there was a hedge fund manager who noticed something strange. The gold price would mysteriously drop during specific trading hours, particularly during the London morning fix. It wasn't random, it was systematic. He started digging and discovered that large banks were using derivatives to suppress the price, creating artificial selling pressure to keep gold from rising too fast. Why would they do that? Because rising gold prices are a vote of no confidence in the financial system. They're a signal that something's wrong with the currency, with the debt levels, with the whole house of cards. That manager started buying physical gold and taking delivery. Not paper contracts, not ETFs, but actual metal. His fund made a fortune when gold eventually broke free from that suppression and ran from $300 to over $1,900. But here's the thing. The same suppression mechanisms are still in place today. They're just more sophisticated, and they're starting to fail. Look at what happened recently with the silver market. There was a massive short squeeze attempt, and while it didn't fully succeed, it exposed just how fragile these paper markets really are. The same dynamics exist in gold, but on a much larger scale. The difference is that gold is money. It's been money for 5,000 years. Silver is industrial, it's monetary, but gold is pure monetary metal. When confidence in fiat currencies cracks, gold is where the smart money runs. And confidence is cracking. You can see it in the bond market. You can see it in the currency markets. You can see it in the fact that central banks, who used to sell gold, are now buying it hand over fist. They know something. They're preparing for something. And if you're sitting there with zero gold exposure, you're essentially betting that everything's going to be fine, that the system will hold together. that decades of money printing and debt accumulation won't have consequences. Let me ask you something. Do you really believe that? Do you really think we can print trillions of dollars, run deficits that would make banana republics blush, and have zero consequences? Do you think the dollar's going to maintain its purchasing power when there are literally trillions more of them floating around than there were just a few years ago? Here's what most people don't understand about inflation. It's not just prices going up. It's your money becoming worth less. It's the silent confiscation of your wealth. You work hard, you save money, you think you're being responsible, and meanwhile the purchasing power of those savings is being eroded year after year. Gold doesn't stop that erosion. Gold is the erosion. Gold is what maintains its value while everything else loses purchasing power. Think about it this way. An ounce of gold could buy you a nice suit in ancient Rome. An ounce of gold can buy you a nice suit today. That's 2,000 years of purchasing power stability. Can you say the same about any paper currency? The dollar's lost over 95% of its purchasing power since the Federal Reserve was created. The British pound, once the world's reserve currency, is a shadow of its former self. Every fiat currency in history has eventually gone to zero. Every single one. Now, I'm not saying the dollar's going to zero tomorrow, but I am saying that the trajectory is clear and the pace is accelerating. And when you combine that with the geopolitical shifts happening right now, the de-dollarization movement, the BRICS nations creating alternative payment systems, the weaponization of the dollar through sanctions, you start to see why gold is becoming so critical. Quick aside here, and this is important if you're thinking about retirement. If you've got $100,000 or more sitting in traditional retirement accounts, there's a way to get physical gold into those accounts without triggering taxes or penalties. It's called a gold IRA, and I put together a free guide that walks through exactly how it works. It's in the description below. No pressure, but if you're concerned about protecting your retirement savings from currency debasement, it's worth looking into. All right, back to what's happening in the market right now. The technical picture for gold is incredibly bullish. We've broken through major resistance levels that held for years. The chart pattern is textbook accumulation followed by breakout. Volume is confirming the move. And most importantly, the fundamentals are aligning with the technicals in a way we rarely see. When you get that convergence, when the stars align like this, that's when you get explosive moves. But it's not just about the price going up. It's about what that price represents. Gold rising is the market's way of saying that something's wrong with the monetary system. It's a warning signal. It's a flashing red light that most people ignore until it's too late. The smart money doesn't ignore it. The smart money is already positioned. The question is, are you? Let me tell you about what happened in the 1970s, because there are eerie parallels to today. Back then, we had inflation, we had currency instability, we had geopolitical tensions, we had an energy crisis. Sound familiar? Gold went from $35 an ounce to over $800. That's not a typo. That's a 20x move in less than a decade. People who owned gold preserved their wealth. People who didn't got crushed by inflation. Now, I'm not predicting a 20x move from here, but I am saying that the conditions are similar. Actually, they're worse in many ways. The debt levels are higher. The money printing is more extreme. The geopolitical tensions are more severe. And the faith in institutions is lower than it's been in generations. All of that points to gold having significant upside from current levels. Here's something else that's fascinating. The mining supply of gold is actually declining. It's getting harder and more expensive to pull gold out of the ground. The easy deposits have been mined. The ore grades are declining. The costs are rising. Meanwhile, demand is surging. That's basic economics. When supply is constrained and demand is rising, price has to go up. There's no other way to balance the equation. But the paper market doesn't reflect that reality. The paper market is about speculation, about leverage, about banks creating synthetic supply through derivatives. That's why there's such a disconnect between the paper price and the physical market. In the physical market, premiums are elevated, delivery times are extended, dealers are struggling to source metal. That tells you the real story. The real story is that physical gold is tight and getting tighter. Now, let's talk about what happens when this tension resolves. When the paper market finally has to reconcile with physical reality. It's not going to be gradual. It's not going to be orderly. It's going to be a scramble. Everyone who thought they owned gold through paper contracts is going to realize they own a promise, not metal. And promises don't spend. Promises don't protect wealth. Physical metal does. I've talked to dealers who are seeing unprecedented demand from wealthy individuals, not retail investors buying a few coins. I'm talking about people writing seven-figure checks for physical gold and taking delivery. These are people with access to the best financial advice money can buy. These are people who understand markets, who understand risk, who understand what's coming, and they're moving into gold in size. The institutional side is even more interesting. Family offices, which manage wealth for ultra-high net worth individuals, are increasing their gold allocations significantly. These aren't speculators. These are multi-generational wealth managers who think in terms of decades, not quarters. When they move into an asset class, it's because they see fundamental reasons to be there for the long term. And then there's the central bank buying, which I mentioned earlier, but it's worth diving deeper into. Central banks are supposed to be conservative. They're supposed to be boring. They're supposed to hold safe, liquid assets. And yet, they're buying gold at record levels. Why? Because they understand that the current monetary system is unsustainable. They understand that when the reset comes, and it will come, gold will be the asset that maintains value while everything else reprices. Think about what a monetary reset would look like. It doesn't have to be dramatic. It doesn't have to be overnight. It could be gradual, a slow shift away from dollar dominance toward a multipolar currency system. But in that transition, what's the one asset that every country, every central bank, every serious institution will want? Gold. Because gold is the only asset that's nobody's liability. It's the only asset that doesn't depend on someone else's promise to pay. That's the key insight that most people miss. When you own stocks, you own a claim on future earnings. When you own bonds, you own a promise to be repaid. When you own dollars, you own a liability of the Federal Reserve. But when you own gold, you own an asset, period. No counterparty risk, no default risk, no promise that can be broken. Just pure, tangible value that's been recognized for millennia. Now, I know what some people are thinking. Gold doesn't pay interest. Gold doesn't pay dividends. Gold just sits there. And that's true. But that's also the point. Gold is insurance. It's wealth preservation. It's the asset you own, so that when everything else is falling apart, you have something that holds value. You don't buy fire insurance hoping your house burns down. You buy it so that if it does, you're protected. The same logic applies to gold. You don't buy gold hoping the financial system collapses. You buy it so that if it does, or even if it just wobbles significantly, your wealth is protected. And given everything we're seeing, given the debt levels, the money printing, the geopolitical tensions, the currency instability, having zero gold exposure is like having zero fire insurance on a house made of kindling. Let me give you another historical example that's relevant. In 2008, during the financial crisis, gold held up remarkably well while everything else was crashing. Stocks got crushed. Real estate got crushed. Bonds were volatile. But gold? Gold maintained value and then went on to make new highs. Why? Because in times of crisis, people flee to safety. And gold is the ultimate safe haven. We're potentially facing a crisis that makes 2008 look like a warm-up. The debt levels are higher. The leverage is greater. The interconnectedness of the global financial system is more extreme. And the tools that central banks used to fight the last crisis, mainly lowering interest rates and printing money, are already exhausted. Interest rates are still historically low. Balance sheets are already bloated. What happens when the next crisis hits and they've already used all their ammunition? That's when gold really shines. That's when people realize that all the paper wealth, all the digital entries in computer systems, all the promises and IOUs, they're only as good as the system that backs them. And if that system is in trouble, you want something real, something tangible, something that's been money for 5,000 years and will still be money 5,000 years from now. Here's another angle that's often overlooked. The younger generation, the millennials and Gen Z, they're more skeptical of traditional institutions than any generation before them. They've seen the 2008 crisis. They've seen the bailouts. They've seen the wealth inequality. They've seen the money printing. and they're looking for alternatives. Some are going into crypto, some are going into gold. But the smart ones are doing both, understanding that diversification across non-correlated assets is the key to wealth preservation. And speaking of crypto, there's an interesting dynamic happening. Bitcoin is often called digital gold, and there's some truth to that. But here's the thing. Gold has 5,000 years of history. Gold is recognized globally. Gold is held by central banks. Gold is physical and can't be hacked or lost in a hard drive crash. Bitcoin is an amazing innovation, and I'm not knocking it, but it's not a replacement for gold. It's a complement. The two can coexist, and smart investors are holding both. But back to the immediate situation. The gold market is setting up for what could be a historic move. The fundamentals are there. The technicals are there. The sentiment is shifting. And most importantly, the smart money is positioned. The only question is whether you're going to wait until everyone else figures it out, or whether you're going to act while there's still time. Because here's the reality. When gold really starts moving, when it breaks through the next major resistance level, and the momentum traders pile in, when the financial media finally starts paying attention, and the general public gets interested, that's when premiums explode. That's when dealers run out of inventory. That's when you're paying significantly more for the same ounce of gold you could have bought earlier at a better price. I've seen this movie before. I saw it in the run-up to the 2011 peak. I saw dealers completely sold out. I saw premiums at 10%, 15%, even 20% over spot. I saw people desperate to get physical metal and willing to pay whatever it took. And that was with gold at $1,900. Imagine what happens if we're heading to $4,900 like Goldman is predicting. The scramble for physical is going to be intense. Now, let me address the elephant in the room. Some people say gold is in a bubble. Some people say it's overvalued. Some people say you've missed the move. But when you look at gold, relative to the money supply, relative to the debt levels, relative to the stock market, it's actually historically cheap. Gold as a percentage of global financial assets is near all-time lows. There's massive room for gold to increase its share of portfolios without being anywhere near bubble territory. And here's the thing about bubbles. They require euphoria. They require everyone talking about it. They require your taxi driver giving you tips on how to invest in it. We're nowhere near that with gold. Most people still don't own any. Most people still think it's a barbarous relic. Most people still don't understand why they need it. That's not a bubble. That's the early stages of a major move. The real bubble is in complacency. The real bubble is in the belief that the current system can continue indefinitely. The real bubble is in the faith that central banks can print unlimited money without consequences. That's the bubble that's going to pop. And when it does, gold is going to be the asset that people wish they owned more of. Let me give you one more piece of the puzzle. The derivatives market. There are hundreds of trillions of dollars in derivatives outstanding globally. These are complex financial instruments that are supposed to spread risk, but in reality, they concentrate it. They create interconnections between institutions that nobody fully understands, and they're all based on the assumption that the underlying system is stable. What happens when that assumption is challenged? What happens when counterparties start to fail? What happens when the web of derivatives starts to unravel? You get a cascade. You get a crisis that spreads faster than anyone can contain it. And in that environment, what's the one asset that has no counterparty risk? Gold. This isn't fear-mongering. This is risk management. This is understanding that the financial system is more fragile than most people realize. This is recognizing that having some portion of your wealth in an asset that's nobody's liability is just prudent. It's common sense. It's what wealthy families have done for generations. And here's the beautiful thing about gold. You don't need to get the timing perfect. You don't need to predict exactly when the crisis hits. You just need to own it before everyone else figures out they need it. Because once that realization hits, once the herd starts moving, it's too late to get in at reasonable prices. The setup right now is as good as I've seen in years. The fundamentals are aligned. The technicals are confirming. The smart money is positioned. Central banks are buying. Wealthy individuals are buying. Institutions are buying. The only people not buying are the ones who don't understand what's happening, or who think they have more time than they actually do. So here's my question for you. Are you going to be the person who looks back in a few years and wishes they had acted? Or are you going to be the person who understood what was happening and positioned themselves accordingly? Because this window won't stay open forever. The gold market is relatively small. When serious money starts flowing in, when the general public wakes up, when the crisis everyone's worried about actually materializes, that's when you'll wish you had moved sooner. The risk of owning gold is that it sits there and doesn't do much. The risk of not owning gold is that everything else falls apart and you have nothing to protect your wealth. Which risk are you more comfortable with? Which scenario keeps you up at night? Because in my experience, the people who sleep best are the ones who have diversified their wealth, who have some portion in physical gold, who have taken steps to protect themselves from the monetary chaos that's increasingly looking inevitable. This isn't about getting rich quick. This isn't about speculation. This is about wealth preservation. This is about making sure that the money you've worked hard to earn, the savings you've accumulated, the retirement you've planned for, that all of that is protected when the system that we've all taken for granted starts to show cracks. And those cracks are already appearing. You just have to know where to look.